The content discussed in this podcast is for informational and educational purposes only and should not be construed as financial or mortgage advice. Always consult with a licensed professional before making any decisions regarding mortgages or financial matters.
Welcome to the Canadian Mortgage Show. Here are mortgage professionals Alex Pang and Alex Shanks to cut through the BS and educate Canadians on all things mortgages and real estate.
Welcome to another episode of the Canadian Mortgage Show. I'm your host, Alex Pang, along with my co-host, Alex Shanks. Alex, what do we have in store for today?
Today, I thought we'd talk about first-time homebuyers. How does the mortgage process actually work? How to get into a house? I find that, and the whole point of our podcast is we want to cut out that BS. We want you to be able to take this information, go to your bank, go to a mortgage broker, go to your realtor. It seems to be like we like to hide things from people. And to me, it's everyone should know about it. And so I thought, let's just break it all down for everyone.
Absolutely. I know buying your first home is exciting. You're finally moving out of mom and dad's basement, or you're sick of renting, right? Being rent evicted or having to move because people sell all the time. You want to have a place you finally call your own, have some roots, maybe where you are in your life, you getting married soon or laying down roots. But yeah, it's an exciting time. It's also a stressful time. So we're here to help you navigate that process and make it smooth, exactly what to be prepared for.
Yeah, we'll give you a bit of a guideline of kind of step by step what you want to do. And so we're going to walk you through that here. And so sometimes the first question I find, Alex, is should you talk with a realtor or should you talk with a bank or a mortgage broker? What do you think is the first step during this process of buying your first home?
I find most people talk to a realtor first because they want to look at a place first. That's the exciting part. The exciting part is to look at a property, not getting a mortgage. That's the least exciting thing.
You don't want to give documents? That's not fun.
It's exciting what you and I do, but we're weird people. But for the most part, the general public wants to buy a property first. And unfortunately, it should not be. You should take care of your financing first. You should speak to a mortgage broker or your bank first. And so you don't waste people's time. You don't waste realtors' time. You don't waste your time looking at properties you have no business owning or can qualify for. And it'll help you with your expectations, your emotions. Exactly. You don't want to go through that huge hope and then crash of disappointment when reality slaps you in the face.
That's the worst thing is there's three things. You find the perfect home, you love it. You then find out for one, you may not qualify for it. Maybe you figure out a way to do it. It sells on you. Every time you drive past that place now, you're going to be like, oh my God, I can't have that house. And every other place is just not going to be the same. And that's where figuring out your finances first, so you know what you're going to qualify for, is a really important part of it. I still believe like you definitely want to go and see what homes look like. And that's where there's really good realtors that are going to be there to guide you, but also to make sure that your financing's ready to go.
Absolutely.
Now, I want to talk about like the step-by-step of what if I want to go get my credit checked? Say if you're coming to me, Alex, and I'm like, I want to know what I'm going to be doing, but I don't want you to check my credit. Why does everyone think it's such a bad thing?
Well, there's a kind of belief there that when you get your credit pulled, it hurts your credit. That may be true in some respects, like your credit score may go down a few points, but the point of building your credit is for times like these when you are applying for a mortgage or you're applying for a loan. Now, true, if you apply for many things in a short period of time, like you get the Bay card, you get the Brick card or whatever, don't pay for 6 months, or if you apply for the Bay card, you'll get 10% off your purchase today. A lot of people doing all these promotions kind of thing. Now, if you do that in a short period of time, yes, your credit does go down. But the purpose of building credit is for times like these, is so that when you are borrowing money, you know what you can qualify for. And a lot of times I get people asking me, and you probably too, Alex, oh, can you just do a number crunch without pulling my credit? I used to do that. I try not to do it anymore because the numbers I can give you is laden with caveats. Assuming you have good credit, assuming you got this, assuming that. I usually tell people, let's get the stress out of the way now, because we're going to have to do it, because I don't want you to base a decision on a guess, right? Do not base a decision. And honestly, I don't want to waste my time. So get it done, pull your credit. Let's get all your docs and make sure, get the stress out of the way now. So when the time comes, when you're in a time crunch, you know exactly where you stand and there's no surprises.
Yeah. And that's where like our job is to help with the financing. But because we're in credit all the time, if there's issues, we can tell you exactly what to do to fix it. There might be some small thing. We can talk with the credit bureaus to say, hey, you've been reporting it wrong. Sometimes your names are mismatched. And if we don't know about that, you put an offer on a house, it's going to make it really bad. And that's our goal is to help you. And so don't
Exactly.
worry about a credit check. It's not the big scary thing that they've. I feel like maybe it was even mortgage brokers that put this out there of, oh, if you go to all these different mortgage brokers, the banks, it's going to be bad for your credit. You actually get 45 days. Let's say I come to you, Alex, and then I want to go talk to my bank. If we pull it, you get 45 days. It's not going to damage your credit. That we're going to see that you've gone to different places. And so don't just go to every single place out there because that will look bad to a lender, but it's not going to bring your score down. You want to make sure that you do
Mm-hmm.
have opinions out there to get those options.
Now, one of the things that, like I mentioned, is important to pull your credit up front is because there may be issues that you don't think are a big deal, but it becomes a big deal to the lender. For instance, what I hear a lot is I didn't pay my cell phone bill because I didn't agree with the charges. So
Yeah.
I'm like, screw you, I'm not paying for it. I understand your principle behind it. Unfortunately, it affects your credit. So
Yep.
you can do something like you can still dispute the bill, pay it first anyway, and dispute it anyway.
After.
That
Yeah.
way you won't get hurt. So those type of things can come back to bite you, especially the cell phone bills.
It's the Shaw cable box. I had a client that she didn't even know they had put a lien out for her because she had never returned the Shaw cable box that she did return. And it had a collection out for her, and her credit score was in the crap because of it. We were able to say, go get that paid off. We got Shaw to prove that she had already returned it. We were instantly in 2 weeks able to get her score back up. And that's
Mm-hmm.
what we're here for.
And
Now,
another important
the
thing
other
too
big,
is,
I'll let you talk there, Alex.
yeah. So another thing that you want to do is check your credit score probably at least once a year. I believe Equifax, you can check your credit score free once a year, I
Yep.
think,
Once a
right?
year. Yep.
And
Exactly.
to at least have an idea where you're at. So when the time comes to apply for loans, applying for a mortgage, where you're at, it's not a huge surprise for you when things come up. And that's the important part of a pre-approval is to get the stress out of the way so that when the time comes, you're not surprised, things aren't hitting the fan, and a whole bunch of people disappointed, stressed, and all that stuff.
That's you just brought up a really good point, and I had another question, but I'm going to ask you, what is the difference of a pre-approval and a pre-qualification? Because
Mm.
we get that thinking that you're pre-qualified and you're ready to go.
So when you go into the bank website, they say pre-qualify in 30 seconds. That may be true, but it's just based on numbers that you plug into a calculator. It's not verified. It's not right. And people tend to embellish their income.
What you mean?
And
My million
whereas
dollars that I say I make isn't true?
yeah, or for instance, someone who works in sales, they just got the job, and maybe 6 months into the job, but they make commission on top of their base salary.
Yep.
If they put whatever their base salary is plus the commission, yeah, that may seem right to them. But in our world, in order to count commission, it needs to be a 2-year average. So unfortunately for them, we can only count their base salary. So those are
Yep.
kind of things that a calculator would not tell you. So
Yep.
pre-qualifying is really just a rough idea. You should not base your decisions on a rough idea.
And
And
that's where
pre-approval
I'll,
is the full thing, is where we do a
okay.
credit check. We have all documents up front, pay stubs, tax returns, bank statements. We can address any of the credit issues. Are you expecting any help from family? If so, how much? And if mom and dad are helping, are they going to have a say on certain things with your bank and with your realtor and all that stuff? Because we all know money is power. And if you're
Yeah.
expecting like help from family, is there caveats to it?
And yeah, that's the kind of the next question I was going to lead into is like, how are different types of income viewed? Because you put it right there, just because that maybe we can't use that income right away. And that's where
Mm.
making sure someone sits with you and talks about how the different type of incomes actually work.
The easiest income is employed. salaried employed, as long as you're full-time permanent with guaranteed hours, we can use that income. Generally, banks and lenders want you to at least have passed probation. Now, there are
Yeah.
some cases where if you haven't passed probation, they can do it on exception. However, you would have to have been in the industry for a longer period of time, like 3 to 5 years. And maybe you just changed jobs and got a promotion and you're still under probation. But because you were, let's say, in this industry, they can use that exception. However, if you are fairly new to the workforce and you're still under probation, they want you to at least pass probation. Now, at the same time, too, if your credit is light, being lenders want you to have at least two active trade lines, meaning credit card, student loan, line of credit, car loan, what have you. So they want you to have at least two active credit accounts for, what's the number of years, Alex? Is it 3 years
It's
or two or
it's
three
ideally,
years?
ideally 2 or 3 years, and that's where
Mm-hmm.
you can have what's called thin credit. You may only have that one
Mm-hmm.
credit card, and a lot of
Mm-hmm.
people only look at the score. They think it's just the score that matters, but the lenders are looking at everything, looking at how long you've had that credit. Now, there's a difference of someone that's new to Canada. We have different programs for them to use because they obviously don't
Mm-hmm.
have credit here in Canada right now, and that's where we can actually look at rent, we can look at their utilities, and even we can use that even for other first-time home buyers on exception. We can go to a lender and
Mm-hmm.
say, hey, they've had a credit card, they just never had anything else, but look, they've paid their rent, they've paid their, that's our job, is to help show you those things.
Now, there are some people who like shy away from credit and they pay cash for
Yep.
everything. And that was
Yep.
a few of my family members back in the day because maybe they've had damaged credit, so they've shied away from it.
Yep.
Unfortunately, the way of the world is we do end up borrowing money, and lenders look at your credit history. If you're going to use mostly debit or cash, I think cash is slowly going away as well. But do have at least two credit cards, maybe pay the balances, use it to collect points, rewards, air miles, whatever, but pay them fully every month so you don't have to pay any interest on it. So that's what I would say.
Exactly. Now, I wanted to talk about what type of benefits first-time homebuyers have, but I also want to add a caveat here of a lot of people get confused thinking that a first-time homebuyer is only someone that has never bought a home before, and they think they get to just do a minimum down payment one time. Can you dive into some of that for me, Alex, to make sure the listeners know there's some differences here?
Well, yeah, there's different ones when it comes to federal and provincial. So we are here in BC, and the way BC works is if you've owned a home ever at any time in the world before, whether it be in Canada or a different country, then you are no longer a first time buyer when it comes to the first time home buyer exemption, where you like up to 500,000 you're exempt, and now that they changed it, it's a sliding scale up to 860, 830, and then sliding scale to 860.
And that's for
That point
that's for
is,
property, that's for a property transfer tax, right?
yeah, and property transfer tax is basically a tax that the government wants for any real estate purchase, any residential real
Anytime,
estate,
over and over,
anytime
even
they
if
want a
the
piece.
homes.
Yeah, they want a piece of all action.
Yep.
Okay, so that's the
Yep.
provincial part. The federal part, a first time buyer is if you haven't owned a home in at least 5 years under your name. Now, correct me if I'm wrong, that includes, is it just you or also your spouse, Alex?
So yeah, so let's say if you, and I think it's like 4 full calendar years. And so there's a couple different accounts, which is called the first home savings account, where you get to put money in to save up for a down payment. Now, let's say, Alex, you own a house, you're living in it, and your partner is also living in it. They're a first time home buyer, but because they've been living in the house with you, because you've actually owned it, they actually lose that benefit because you are a homeowner.
Yeah, so I guess what Alex is trying to say is even though you're not on title, because your spouse, common law, married to whoever, it owns that property, you are deemed not to be a first time buyer anymore for the purposes of the home buyer plan, which is withdrawing your RSPs. Now, if you sold your property and you've been renting for 10 years, then and you built up your RSPs, you can be deemed a first time home buyer and withdraw your RSPs tax free again as a first time buyer, right? As long as you pass the 4 year mark, neither you nor your spouse own the property for 4 calendar years.
Yeah. And that's where you can even say own a place, you turn it into a rental because maybe you got to move somewhere else. Even though you actually own a property, it's your rental. As long as it has not been your principal residence, you get to use the first home savings account and your RSP. And a lot of people don't realize that. And they're not perfect. They're not these amazing accounts that make buying a home easy. But if you put money into them, you're going to get a tax return, which is going to give you a better benefit the following year.
Yeah, and the government recently increased the threshold for being able to withdraw your SPs. I believe they've increased it from 35,000 to 60,000. Am I correct on that one?
Yeah. Yeah, you're correct there.
And they giving you an extra year to start paying it back. I believe before it was you only get a 1 year grace, but now I think it's 2 years where you can start repaying it back over that time.
Yeah, and we could dive into how those will work. We don't want to overwhelm anyone here of talking about the RSP and the first home savings account, but these are definitely accounts. If you guys haven't owned a home or you're a first time home buyer, you need to make sure that your professional that you're working with is explaining these different accounts to you. Now, there's different types of mortgages in Canada. Can you talk to me, Alex, about what's the difference of insured and conventional? Explain it to me like I'm 5.
Insured is when you are putting less than 20% down and the property's under $1 million. So in Vancouver
but I thought
and the greater...
Someone told me, Alex, that I could only put 5% down one time. I can only buy a house with the minimum down once. That's what I hear from people.
No, not true. You can put down 5% each time. Now, putting less than 20% down, you can only do it if it's a principal residence. So the next property you're going to be living in it and you put less than 20% down, it can be insured. Now, it needs to be under $1 million. And when you're putting less than 20% down, the government requires you to pay for an insurance. It's called a default insurance. Now, there's 3 insurers in Canada. One is CMHC, there's Sagan, and there's Canada Guarantee. Now, the insurance is not for you. It doesn't insure you. It insures the bank, the lender, that they get their money back should you default because it's deemed a higher risk, I take it.
Yep.
But this is a weird thing where if you have an insured mortgage, yes, you have to pay the insurance and you don't have to pay it upfront. It gets added to your mortgage. You actually get a better interest rate. But
it's so weird
because it's insured, it's guaranteed, right? You're putting less down, but you get a better interest rate.
It just seems weird because like other countries do it the other way. They give you, if you have the money, they give you the lower rate.
Yeah, I get it because things changed probably about 4 or 5 years ago when the lending landscape introduced insured, insurable, and we don't want to confuse you guys. There's sometimes us being in the business have a hard time understanding insured and insurable. But now a conventional mortgage is anything where you put 20% or more down. And it can be properties over $1 million. So any property over $1 million, which is very common in Lower Mainland and the GTA, over $1 million, you have to put at least 20% down. Now, and once you reach a certain threshold, some lenders require a sliding scale. Now, first time buyer buying over $1 million, you're pretty damn lucky. And right, you probably have a big help from family, or you're probably working in a tech industry making tons of money or something like that. But most of the time, your first home is, understand, you're not going to hit a home run on your first home. You might have to get in and just live in a 1-bedroom or decide to live further out in the outskirts. Don't think of it as your forever home. Just think of it as, this is a way for me to get into the home ownership space and maybe live there for 3 to 5 years and then upgrade as your career goes along. You meet someone, there's a dual income, your life moves along, then we got to upgrade to a 2-bedroom, a townhouse, or what they call it, attached or semi in Ontario. Yep. And then ultimately the detached home. So that's gone are the days where the first home you buy is a detached house. We're not in the 70s, 80s anymore. We're going to have to start the property ladder with the 1-bedroom condo, the 2-bedroom condo, the townhouse or the duplex, and then starter home, and then maybe the bigger home. And then once you have kids, then you downsize backwards that way. Yeah. But that's probably how it is now nowadays.
And the one thing I see on the insured and conventional that we know we have that different in interest rates where you get the lowest. If you were to type in, everyone goes to Google, they type in interest rates. what gets shown on there is the lowest interest rates, which is those insured mortgages. And it really
Mm-hmm.
confuses a lot of people because they're like, well, why don't I get that 4.5%? You're offering me a 5%, Alex. And having to sit down
Mm-hmm.
and break it down for people saying, you'd much rather have the 5%, you're putting a bigger down payment. You don't want to pay that mortgage insurance. It's a cost that gets added. And that's, I know every time people are always confused that there's a lower interest rate. It does come with a caveat of you have to pay that mortgage insurance.
And there's a whole bunch of lenders who offer ultra low rates, but it's what we call in our industry is called no frills mortgages, where it's
Yep.
laden with restrictions, where you're not able to make any extra payments. You can't break out of it. If you do break out of it, the penalty is like, geez, 3 to 5% of the mortgage
Yep.
amount, like exorbitant. So
Some of
just
them,
so that you can save, yeah,
the bona fide sales clause, you can't even get out of the mortgage unless you sell your property. Like it's,
yeah,
and
exactly.
that's where the fine print, there is a lot to it, and making sure that you're having someone explain that to you of what's the difference of that ultra low mortgage compared to that other mortgage.
Exactly. And it's some brokers out there said it's all about the interest rate. We're saying it's not just the interest rate. You got to look at the terms, the prepayment privileges, and especially where you are down the line in your life. Do you see yourself breaking this in the near future, or you plan on upgrading? Maybe the 5 year fix is not the best idea, right? Have a mortgage professional go through that with you and definitely discuss those options.
Now, the next thing I want to talk about, this is talking about getting into a realtor's job at the same time. But like when you put an offer in, I hear people talk about that subject to financing, subject to conditions. Explain to me, what does that benefit to me if I was a first time home buyer?
So having subjects is basically your get out of jail card, where when you place an offer on a place, generally you have a 5 to 10 business day. They call it due subjects, but in other words, due diligence window, where it could be subject to a home inspection, subject to reading the strata minutes if you're buying into a condo or a townhouse or semi, subject to an appraisal, and subject to financing. So in a hot market, some people were placing offers with no subjects just to be competitive. It's essentially, I'm going to buy this no questions asked, which is so risky, right?
Tell me the risk of it when you're putting less than 20%. Like, why is it become even riskier when you're doing less than 20%?
So when you're putting less than 20%, you are like subject to the insurer approval. So
Yeah.
the qualifying guidelines are rigid. They're black and white. There's no maneuvering if you're putting less than 20% down. So what they say in our world is debt service ratios, where you can go as high as 39% for the housing and total would be 44. There is no maneuvering with that. Now, if you put in a subject free offer and you need insurance and you really didn't get a pre-approval beforehand, you are like, and you don't get approved, you are essentially screwed. And so let's say your deposit, you put in your deposit for what, 20, 30, 40, 50 grand, whatever it is. Not only will you lose the deposit, but you open yourself up for litigation where if the seller resells that property and it ends up
Takes
selling
a
for
loss.
less than what it takes a loss, or they sell it for less than what your offer is, not only do they keep your deposit, they can go after you for that difference and they will
Yeah.
win every time. It's been
Yeah.
proven in court time and time again. So I understand when it's a hot market, emotions are at play, but going subject free is it's risky. Now, we may be able to pre-approve you and we can give you 99% a certainty. You are good 99% of the time. So I have this
Yeah.
whole caveat that I get my clients to acknowledge and reply because honestly, we need to cover ourselves legally too. To say that you may be pre-approved 99% because you are good income, credit, down payment wise. The 1% that can fall off the rails is the property.
Yeah.
If the property is overvalued and it doesn't praise for the value that you won, what you accepted at, or does it have asbestos? Does it have poly B piping? Does it have, is it a former grow op? Is it like, did you buy a piece of crap essentially that revealing through home inspection or strata minutes that the lender says no? Well, if you went subject free, you are up the creek. So I know, like we're not in that marketplace right now where subject free offers are in place, but be forewarned. Have subjects in there to protect yourself, so that worst case you don't remove subjects and you
Make them
are
tight.
you are
Have
off the
someone
exactly.
work with someone that can make it tight, and you have other ways to win your offer. The other scary thing is with that less than 20% is the mortgage insurer. What if we get the lender on board? They're happy with it. They like you, Alex, as a person, your income and everything. There's a problem with the property, especially with strata properties. The insurer may
Mm-hmm.
say no, and you have
Mm-hmm.
no other options. That's it. You're done, and you can't go anywhere else.
Something to keep an eye on when you're looking at, especially if you're tight with your finances, you are based on your budget, you're looking at older properties. What I'm finding is that properties, buildings around the 20-year mark, that's when all the special assessments come in,
Yep.
where they need to fix the roof. And the big thing, what lenders look for is the membrane and water damage. Those are big red flags. So,
In Vancouver, it's
uh,
bad.
exactly. And I'm pretty sure in Toronto too. So make sure to read the strategies beforehand. We'll never ever tell you to say, okay, go subject free, but here are things to
Yep.
guard against it. Make sure the
Yep.
building is maintained very well. It has a healthy contingency fund. And if it's in that
I'll
spot
say
or
one
that,
thing about the
yeah.
market, the difference of BC and Ontario. The one thing I do Ontario does is like here in BC, it's the job of a realtor and yourself to review your strata documents. In Ontario, it's a lawyer's job. And so you're having someone else to confirm that for you, where there's
Mm-hmm.
been many cases that have gone to court that realtors, mortgage brokers have told people, don't worry, you're good. There's no issues with the property. You get into the property, a month later, you find out they're going to ask for $100,000 for a special levy. That is, as a first time home buyer, you put $20,000 down. You can't come up with 100 grand. And that's a very
Yeah.
scary thing.
Yeah. So it's important. Like I've had to read strata minutes for clients because
Yep.
I'm essentially being the lender. I
Yep.
don't care about oh, you got to stop letting people in to the garage and all that stuff, or there's theft
Yep.
happening in the storage lockers. Those things we don't care about. The day to day stuff. Things we're looking for are, oh, there's a building envelope issue in the balcony, or
Yep.
there's leakage, water leak. Anytime a lender sees water leakage, red
Flags.
flags. That's what they see. If you're in that space of looking at older buildings, be careful making sure that the building is properly maintained and there's
Yep.
no big major fixes that are pending. Because yes, it looks nice, but if you have a big special assessment coming, walk away.
Yeah, do your due diligence. Make sure someone's there helping you guide, go over everything. Don't just take any offer, even if you haven't looked at the strata documents.
Mhm.
Another question that we get all the time there, Alex, is what's a deposit and a down payment? What is the difference of that? I've put an offer in. What does that look like?
So a deposit is provided after you remove subjects. Removing subjects means we've satisfied financing, home inspection, appraisal. We're signing off on the strata docs. We're happy with it. In BC, we have to give, it's after you remove subjects, you have to give a deposit within 24 hours, and the deposit will form the down payment. So let's say you are putting 20% down payment, but the deposit usually is about 5%. So that 5%, you put that deposit, but it's part of your full 20%. So by the time
Yeah.
everything financing is arranged, you just provide the remaining 15% at the lawyers plus the legal fees. Now, if you're buying a pre-sale, deposits are pretty much your down payment, right? Unless it operates the same way. Now, most developers in BC, probably in Ontario, they require 20%, or some developers
Yep.
need to want 25. So over a
Yep.
course of a couple of years, you pay 5%, and then another 6 months, another 5%, another 5%, and then you've eventually paid 20 to 25%. Now, oftentimes you pay 20% of the purchase price before GST.
Yep.
So when it comes time to closing, you might have to put a little bit more, because how the purchase price is determined with a lender is purchase price plus GST. That's your total purchase price. So if you've already put 20% on the pre GST price, then you'll have to put another little bit to make up the difference.
Yeah.
And depending
Yeah.
where you are, you might be subject to the property transfer tax as well.
Yeah, and that's where
the two main differences.
you don't need to have the, let's say if you're going to put 100,000 down, you don't need to have that available today. You don't need to give a check for 100K when you remove your subjects. It's going to be your deposit that you're going to give. The other things that we do have to look at in Canada quite heavily is money laundering. And what does that kind of look like? What do we have to look at when we're trying to find someone's down payment, Alex? Let's say I got $20,000 in cash under my bed. Am I good to take that into my offer and be okay?
Doesn't work that way in Canada. I know it could work in Breaking Bad and whatever, but
What? My
um,
cash isn't king. My
yeah,
cash isn't king here.
no, it's great at the casino, or if you want to buy a car, great. But it's getting a mortgage is probably the hardest thing in Canada. Car loans are easy. Everything else is easy. Getting a mortgage is probably the hardest thing. So there are some people out there, probably not a lot, but that just have cash under the bed. Deposit into your bank account and let it sit. Now, what banks look at, depending on the lender, they typically look at history from 30 to 90 days. So 1 to 3 months of history to see that you've accumulated down payment. And what they look for are large, irregular transactions. And I believe the number, I think, is about 5,000 or more of irregular transactions. They'll want to know where it's come from. And if it's a gift from family, that's fine. We just need to account for it, then the amount of number, and then have a family sign a gift letter. Now, when it comes to a gift letter, sorry to go off on another tangent, a gift letter, banks will only allow upward movement when it comes to gifts from family. It could be mom, dad, grandma, grandpa. It's weird. They don't allow uncles, cousins, or brothers, sisters to be gifters. So,
Yeah, it has to be exceptions.
I wish they relaxed that. Yeah.
Yeah, it can be exceptions on that, but yeah, like it needs to be immediate family that way. And that's where it's then again making sure those funds are in there. Now we got to see 90 days. One thing I find that people like to do is they chase the high interest savings account. Let's say
Ah.
EQ today is offering me 5%, but next week TD is going to offer me 8%. What does it look like when I transfer?
Oh, it may sound great, but I'm just speaking from my experience. It's a nightmare to track. So I have had clients who have moving based on the promotional interest rates, and I've actually had to create a spreadsheet to track the movement of the money because lenders want to know the paper trail, right? Because
Yeah.
again, they want to make sure it's anti-money laundering. And we know it's their money is legit. We're not questioning. We just need to track where the money is. And
Yeah.
essentially, in order for me to figure it out, I've had to organize it and put it on an Excel spreadsheet. I don't know if you've had to do it. And I had to explain it with the lenders too. Oh, shoot,
Yeah.
what's this? 5,000, 20,000, 18,000 in and out, different counts all over. And I've had to have clients explain it to me, and I've had to organize it on Excel to help explain it.
Yeah. And it's hard. It back in the day, you just went in, you just said, hey, I got 100,000. There was no questions. The thing is, there's bad people out there that do bad things, that are putting money in that's illegal. And so everyone else gets put on the same light. It's not, never think of if someone's asking for these documents, don't think, oh my God, it's me, Alex, I'm the issue. It's every single person has to get looked at that way. It's a box that has to get checked off. But I know it feels very invasive for people, and they feel like, well, I'm going to hide some of that stuff. I'm going to redact the bank statements.
What banks like, please don't alter your bank statements, because when you alter your bank statements, they think you have something to hide.
Yeah.
They honestly don't care about your Uber Eats eating out 5 days a week. They could care less about that. They don't care about your Disney Plus or Netflix subscription or whatever. They honestly just care about the large irregular deposits, anything like that.
And they need to see that the funds have been there for that 90 days, because if you just got a deposit of 50K, they're going to say, well, where did that come from?
Where is it from?
You're going to have to explain.
Yeah. And if it's a great gift, great. Or, hey, if you won money in the lottery, you can explain that, right? And as long as you prove that you did win it in the lottery, or you won in the casino or something, I'm sure there's a deposit slip somewhere that you could prove it.
Totally.
If it's legit, it's legit, right? There's ways to prove
That's the same with selling vehicles, selling like toys and everything. Again, you're allowed to do it. We just have to trace it. And don't take it personally when someone's asking for those documents from you.
Yeah.
Uh,
So
uh,
another
uh,
thing I hear a lot from older clients too, it wasn't like that when I first got my mortgage, like
yep,
10, 20, 30 years ago. Life has changed. Like
yep,
there used to be cases where this is even the beginning of my career where it was like 35% down, no questions asked,
yep,
especially for self-employed or whatever. You don't need to confirm your income. You just need to sign this letter and say, "Oh, I make 200,000 as a Uber
yep.
driver," or even this is Uber, but something like that. And they didn't have to
Ninja
verify.
ninja loans.
Yeah. So that was the case, excuse me, where the whole global financial crisis happened, where it was more so in the US, where they're giving out loans to people that had no business, no
Yep,
job, no problem, zero down. And
yep,
that created a house of cards that collapsed. So good thing in Canada, we're more conservative than that. But
yep,
I think there's a saying that I like to say, the banks have the money, so we have to follow their rules. It's just not easy.
yep.
We're not trying to make your life difficult. We know what the banks are asking for. So we're not trying to give you a hard time. So what we're asking for is help us help you.
Exactly. That's it's. We're not doing it just for the fun of it. A lot of people sometimes, I
Mm-hmm.
think they think I'm there sitting there like, oh yeah, I'm going to get these documents here today.
Exactly.
Now, if I'm trying to buy a house, can I go and finance a vehicle at the same time? What does that look like for me? I want to go buy my house, but I also want that brand new Tesla.
That's a big no. So you may want that car because you got a big promotion. I want to congratulate you. That's fantastic. Please do not get that car until after you get your mortgage. Once you get your
Yep.
mortgage, you can do whatever the hell you want. Okay.
Yep.
Obviously, within reason. How it works is if you get a car loan, it's essentially you're paying, like there is a debt attached to it. You have a car payment, and it essentially reduces what you can qualify on the mortgage side. And there's this number, it's not exact, but it works out to every $500 a month in monthly payment when it goes to a car loan or any loan payment, it reduces what you can borrow on the mortgage side by 100 grand.
Yep.
So now Teslas could be anywhere from 1,000 to 1,500 bucks a month, depending on what model Tesla you have. I know some people who have a Model S, they're paying like 25, 3,000 a month. That's
That's
great.
that's
But
that's insane. That's higher than
yeah,
that's higher. Like I can't live in that thing. It doesn't have a kitchen. It doesn't have a bed for me.
but Alex, I can take the Lambo off the line and I can kick his ass. I'm like, good for you, man. We're not 18 anymore or
Yeah.
whatever. But yeah, yes, you can get the car, but wait till after the mortgage. Another thing on top of that is, oh hey, can I quit my job before we move into the place? Oh,
Ooh,
now that we got an
that's
approval, what do you think? What
yeah.
do you say to that?
Definitely can't quit your job. The lenders have up to the day of, and this is the same thing. You think of like I close on, let's say, on the first of the month. I'm going to quit my job on the 31st. They have the same day of closing. They get to call to confirm if you are still employed. So that's a big no. Again, obviously, after you close the mortgage, what happens then? No one's going to be calling, but you got to keep your job. You can't finance anything because that debt is going to show up against you. Now, if it was talked about, let's say, Alex, I came to you, I made really good income, I was that software developer. Again, if your income allowed you to qualify, then you could be looking at that. But someone has to sit with
Mm-hmm.
you to talk to you about what it's going to do to you.
Yeah, I've had clients where it's dual income and the spouse wasn't making as much, but she wanted to leave. And they are
Yep.
closing on their property soon. It was probably a month or two away. They like, please tell your wife not to quit. I know she hates her job,
Yep.
but just hang in there.
Yep.
You don't want to jeopardize your mortgage approval. Just hang in
Yep.
there. Yes, we have a mortgage approval, but like you said earlier, not every lender will call to verify last minute, but there are some who do. And we don't know if they decide to or when, or if they decide to audit and do that. So why jeopardize your mortgage approval because you hate your job? I know you hate it and it's killing you inside, but what's more important is getting into the home that you bought or dealing with that boss that you actually hate. Yes, just deal with it. And once you get into the mortgage, you've closed on the property, you get the keys, you moved in. Same thing as a car loan. You can do whatever you want. Okay.
Yep.
But yeah,
And
that's
they
what I have
don't,
to say
you go,
about that.
you walk into the car lot. They don't care. They're not going to look at your mortgage payment. They're not going to say, oh, you can't qualify for that. They just care. You have good credit. You got a pulse. They'll give you whatever you want for a car loan. A mortgage
Mm-hmm,
is
mm-hmm.
a way different beast. and you got to make sure you qualify, and don't post stuff on social media. A lot of people, I've heard people that post, I'm quitting my job. Banks and lenders, it is a very easy thing to track that. And so you do have to, this is someone lending you potentially $5 to $1 million. Like they have the right to figure out who are they lending that money to. So you do have to be cognizant of what you're posting out there.
Yeah, another thing, once you have a mortgage approval, I wanted to add is, like we said, don't quit your job. Don't take on buy a car or co-sign a loan for anybody else. I know you're going to move into a place, so you probably would need to get furniture. Don't all of a sudden rack up your credit card. And because we're like, oh, I need to buy new TV, new comfort set, new bedroom set, that could easily be 20, 30 grand. Okay.
Yep.
Yes, I know you need new furniture. That's great. I'm not saying don't buy that stuff. And especially the brick don't pay for 6 months kind of thing. Have some delayed gratification. Get your place first. And I'm sorry I'm repeating myself, but do whatever you want afterwards. Okay. Get in the place. Then buy all that stuff. I know you want to have it all ready when you're moving in, and we want a perfect life and timing is perfect. But when it comes to the financing part, please don't do that. Right. Let's not jeopardize that.
Yep.
Hold off, move in first, then you can do whatever you want afterwards.
Yeah. And this one kind of just starting to like finish it off here. You already talked on it a little bit before there, Alex, but should I be waiting? Is it better for me to keep saving to buy my forever home, or do I just get in the market? What's like some of your thoughts that way?
I get asked this all the time. When's the best time to get in the market? My saying is, unless you're investing and you're buying to live in yourself, you buy when the time is right for you. It doesn't matter what the interest rate is. Sure, some environments are better than others, but if you're sick of living with mom and dad and you just can't take them meddling in your life anymore, or you're in a crappy rental and you just can't deal with the landlord or your neighbors and all that stuff, it doesn't matter whether the interest rate's 4.5%. It's when it's time to make a move, it's time to make a move. And we've seen clients where they have this analysis paralysis, where I had a client where they were looking back in 2019 and their budget was here, but their expectation was here. So what they were hoping for is, oh, we'll wait till prices come down.
Price.
You know what? In order for prices to come down, it had to go up. So they witnessed pricing go up like crazy during COVID. Like we're talking like 30, 40%. And yes, it's come down since then, because from the peak, it's probably come down maybe 10 or 15%. But it's already went up 40%. So it's already up 25% from when they looked in 2019. Now they finally closed on a place. And like at the time they're looking at homes back in 2019, it was $1 million. And you could get $1 million home for $1 million in the area that we live in, same area.
Yeah.
But they finally bought a home 5 years later because they finally made the move. They bought a house, not in our area, but it's 1.3. Yes, there is a balance between waiting to save and there is a cost of waiting as well. You buy when the time is right for you.
Exactly. My thought, real estate has an investing portion to it, but it also just has a life portion of you want your own space. You want to know that you can paint the walls, you can hang up on it. You can't really put a dollar value on that. You can't say, hey, this is worth to me that. You have to figure out what you want in life. Real estate has been very good for many people. Now, obviously, every market's different. Now, me being a first-time home buyer trying to buy, say, downtown Vancouver, it may actually be cheaper for me to rent and actually invest that money. And that's where, again, it's looking at the different scenarios, because obviously to buy a condo downtown Van, $1 million, well, my rent on that is maybe $2,500. My mortgage could be $4,500 to $5,000. That's where we start to get to what's actually better for you.
Absolutely.
Well, I think we gave the listeners here today, Alex, a good overview of what it looks like as a first-time home buyer. Now, our goal is always to be providing you guys that information. If you guys need more information, if you guys want to find out more, please let us know. Hit the subscribe button. That's how we're going to know if you guys are liking what we're doing. Send us notes. We're always here to help. But make sure that you guys reach out to any professional before you guys start looking at buying a home. This is Alex and Alex Pang with the Canadian Mortgage Show. We'll be in touch. Talk to you soon.
Now, if you enjoyed this episode, make sure to like and subscribe. If you're listening on Spotify or Apple, make sure to follow us. Please give us a 5-star rating. You can even send us an email because we want to know what you guys want to hear about. That's what we're here for. Reach out anytime.